Hi, welcome to Let's Talk Bonds, the weekly bond podcast from INR Bonds. I'm Arjun Patsati. And in this week of heavy volatility in markets caused by the Russia-Ukraine crisis, there was a heavy placement of bonds in the private placement space, where many issuers came out with issuance of corporate bond, largely in the 2 to 3 year maturity space, catering to the market demand for bonds. And this is clearly because the market believes that interest rates are rising and going to go up over the next 1 to 2 years. And given this scenario, there is very little interest in the investor appetite for longer term maturities in bonds in the corporate bond space. And if you're with the heavy supply of government bonds in the fiscal year next year, the government bonds too expected to see yields move up. So in the options for investors at this point of time, unfortunately, given that RBI is still maintaining rates at record low levels, the returns in the bonds, in the corporate bonds, from companies, well-known companies, highly rated, who are issuing 2 to 3 year bonds are still very low. And so they still have to look elsewhere for higher returns. There are many other companies coming out with higher returning bonds as well. We'll take you through those levels. In this last week, we saw the government bond yields moving up again because the government announced an auction, and uh, with oil prices rising very sharply on the Russia-Ukraine crisis, causing inflation fears, government bond yields went up. So the 10-year bond yield went up also last week. Largely, the 2 to 3 year and 5 year bond yields were still below around 4.5 to 5%, 6% levels. The 10-year bonds going up to 677, and the 15 and 30-year bonds at over 7% levels, while the state development loans, the 10 years saw levels of around 7.10%. The Bharat bond ETFs too reflected the movements in the government bond yields, the 2032 space, and they went up over 7% levels, while the uh, 1 year 23 maturity ETF was below 5%, and the 25 maturity ETF was still below 6%. On the corporate bond space, again, AAA rated bonds, 2 to 3 year bonds were largely below, 2 year bonds were largely below 6%, 3 year below 6.5%, 5 year around 6.5 to 7%, and 10 year over 7%, going up to 7.5% for many of the AAA rated bonds. While so in the private placement space, while lower rated bonds or the higher yielding bonds were largely in the 2 to 3 year segment, they were between 7% to 8% levels. 5 year could be uh, around 8.5 to 9%. We saw Shriram City Union Finance um, issuing a 10-year bond at 9% uh, yields, given the shorter maturity bonds are still available at between 7 to 8%, and 8 to 8.5%, a little aggressive in terms of yields, but they have issued the bond. We saw then again my companies coming in at um, uh, 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 microfinance companies and a few others trading in the 9 to 10% for 2 to 3 year maturity bonds. Uh, so that's largely the uh, secondary market. On the primary market space, we saw a lot of issuances. So we had the NABARD, the SIDBI, small, and these are all PSU names issuing 2-year bonds below 6%. Um, you had Bajaj Housing Finance again issuing 2-year bonds below 6%. The India Infra Debt issued 5-year bond at over 7%, 7.15%, while we saw HUDCO, the Housing and Urban Development Corporation, again a PSU name, issuing short maturity bonds at very fine levels of below 6%, or just over 6%. We on the lower rated City Corp Finance came out with the 1-year bond at below 5%. Tata Capital issued 2-year bonds at below 6%. So did Tata Housing Finance. Very aggressive yields, but a lot of demand for these short-term bonds from all kinds of investors, largely because no investor wants to take higher interest rate risk, and they are very happy with lower returns offered by higher AAA rated companies. Shriram Transport Finance, where traditionally the yields have been trading at much higher levels for a period of time. 2 and 3-year bonds were issued at over 7% levels, 7 to 7.4% levels. And there were a lot of other MLDs as well, companies issuing MLDs. But before that, Aadhar Housing Finance came out with a 4-year floating rate bond. This is benchmarked to the repo rate at 7%, which is closer to 300 basis points spread over the, or 3% spread over the repo rate. And if the repo rate rises, say, by 1%, then the coupon rate will go up by 1%, which will become 8%. And if it's going, repo rate is higher by 1% over the next 1 year, then you'll get the Aadhar Housing 3-year bond at 8%. And if it goes up by 2% over the next 2 years, you'll get Aadhar Housing 2-year bond at even 9%. So, which is a very good yield. But the question mark is, where will the repo rate be over the next 1 to 2 years? You have the MLD issuances included Navi Finserv, you had JM Finance, then you had Kotak Prime, Edelweiss group companies. All these were issuing MLDs. MLDs are market-linked debentures linked to the 10-year GSEC, and these are also largely 2 to 3 year, 2-year MLDs. That's where the most of the demand is at the ultra high net worth investors. And you had Vivriti Capital, that's a New Age NBFC, issuing 2-year bond at 10.2%. These are some of the private placement issuances. So clearly investors do have a wide choice. Demand is definitely there, only at the short end, which is 2 to 3 year maximum. And the choice is between below 6% to or 7 to 8%, or even 8 to, if we can see a good bond, to 8 to 9%, or even 9% plus. And our app, Quick Invest by INR Bonds, we have listed bonds for your investment, where you can invest in bonds, 2 to 3 year maturity bonds, even 1-year bonds, which are offering attractive levels. We give you the most information. With our own proprietary risk score, you can take your decision and invest directly through our app with the easiest of investment processes. So do download the Quick Invest by INR Bonds app on your iOS and Android. And those of you following us on YouTube, Spotify, Amazon Music, Apple Podcast, please do follow us. Thank you very much for listening in.